All right, so let's get going. Now this, as I'm going to try and so we can spend a bit more time this morning. Maximum we have around 3 hours, although I don't know if I can last that long. I don't know if you can last for 3 hours, but we'll do our best. Okay. What I want to do today, actually, there is a last set of practice questions that I would like to go through. Set number 3. Now, I understand Govert already went through with you the other set on early exercise. Am I right? So he did that on Friday. So I will cover the remaining. I received some questions from some of you. I want to thank all of you for writing to me. I really mean that. It helps me help you a lot. And I think sometimes one way for me to get to know you, all right, is when I ask questions and I see what answer you give. But the other way for me to get to know you is when you ask me questions and I see what kind of questions you are asking. Okay, so that also tells me something. And I want to thank especially Vincent. He's here? Okay. I really appreciate that. And I have also put together some notes that I think will be helpful for you on various aspects of the course, even if we don't go through all of it today, which I don't think we can or should. I don't think we should, but it's there. Okay? And then we'll wrap up from there. So first of all, so the final exam, together with the individual assignment, will be happening on March 2nd, on Friday, you know, and so all the tutorials are on YouTube. I don't normally do that, but I have done it for this course because I appreciate, I am aware of the complexities. Complexity is such that it's not like there's 15 pages of partial differential equation you have to memorize. It's not complex like that. It's complex in that you have to listen and you have to think, and watching the videos may be a better medium for this course anyway. So I am recording now as we speak, and I will put that online too. So that's for today. So the exam will be on Friday. I could say the exam is next month, which it is, but next month is next week, or this week, if your week starts on Sunday. So it's 6:30 in CYT in the big one. We might do a seating plan, just a really simple one. It will be 3 hours. It's going to be closed book, multiple choice. There will be approximately 50 questions. Now, how does that work out? So 180 divided by 50 is 3.6 minutes per question. So I would advise you to time yourself well. And if there's something that you're not sure, either just skip it or guess. Okay, there's no negative marking. One thing I would advise you is, you know how when you fill in those bubble sheets, okay, and some students, when they are answering questions and there is a question, they're not confident and they want to go back to it, so they skip it, which is fine if that's what you want to do, but make sure you do skip it. If everything is out by 1, boy, you have a disaster, okay? And I don't know if we can really help you. It nearly happened one time. So I speak, you know what I'm saying? All your answers are out by one, right? I speak from experience. So don't let that happen to you, because I may not be able to help you. You tell me you're out by one, but how do we know if it's after the fact? Okay. Uh, Now, there's something not quite right with my machine this morning. And then, all right, just hold on one second. Oh, it's driving me crazy. Okay, that's a bit better. Now, it may be just as well that we don't use the dual screen mode, because this thing is a little bit cranky. Now, so for the final exam this Friday, I would advise you to pace yourself and be careful you don't skip the questions by mistake. Also, please bring your make sure you have pencils and eraser and your calculator. If you, it's funny because when we were doing the capital markets quiz yesterday, I saw some people when they were filling in the bubble sheets, they fill in one of them and then they cross it out and they fill another one. No, the machine, we're going to machine mark this. The machines will go crazy if you do that. Okay? So please make sure you bring an eraser. So they will be mostly calculations and analysis. The style will be quite similar to the questions that we have been using for practice with you guys. Okay. Now, I want to start with this one. So related to pin risk, I'm not clear about pin risk. I have checked Investopedia, which is a dangerous thing to do. Don't trust the internet on everything, okay? Especially medical. And it tells me pin risk is the risk a writer of an option faces when the underlying asset closes at or very near the exercise price. Well, that is strictly speaking correct. Doesn't tell you much. I cannot understand why the writer should care whether the long side will exercise. I just think because it's at the money, the payoff has already been determined. Actually, the payoff is near zero. I really cannot understand why there exists the risk. Okay, pin risk is this. Let me open up my notes. Okay, you don't need to look at that. Trading. So today is 9 and 10. Now, if you just go and if you just open up any option pricer, and pin risk is an interesting challenge because it is real, and I have first-hand experience in real markets. So let's say you have an underlying and the price right now is 100, exercise is 100, and it's a 1 month option, so 30 days to expiry. Now, keep an eye on the delta. So you know it is roughly 50 delta, okay? Suppose you are very, very close to maturity. So I change nothing except days to expiry, and I hit calculate. Now the delta is still around half. I change it to one day, okay, or half a day. Now, when I do that, the moment the underlying price goes up, let's say to 101, your delta rapidly shoots up. In fact, the closer you are, so let's say 0, 0, I don't know if it's going to take 0, 0, 1 as an input for time, okay? Now the delta is now 1. Now let's say the price goes to 99. In fact, even 99.5, okay? Delta is now 0. In fact, I can even go 99.9. Delta should be 0, or very close to 0. Maybe that's too close. Okay, 99.75. That's close enough. Okay. So I'm going to put 0.001. So you are literally maybe just a couple of hours, or you are minutes away from expiry, and the market is hovering up and down, in and out, in the money, out of the money. Now if I go even par 10, the delta is close to 1. Now what is actually going on here? What is going on here is, you know how at expiry, this is your option payoff, and if you are very, very close to option expiry, so your payoff might look like this curve. Is not so much of a curve anymore, but when you are here, your delta is very, very close to 0, but while you are there, your delta is very, very close to 1. So you can't really hedge it. Delta 0 means you don't need to hedge. Delta 1 means if it's a contract for 100 stocks, you have to buy 100 stocks. Okay, so you find yourself when it's hovering up and down, suddenly, oh, buy 100, sell 100, buy 100. You can't do that on the last day. Okay, so what do traders do? Two things you can do. Okay, one, you just have a view. Either you hedge it or you don't. Okay, just leave it. You can't hedge. So if you think it's going to be in the money, hedge it completely. If you think it's going to be out of the money, don't bother. Okay, now that's called a pin risk. The second thing you can do, let's look at your question a bit more carefully. I cannot understand why writers should care the long side will exercise. This is just moments before the expiry, and I'm really talking like half an hour before expiry, and you are right at the money. So it's very, very difficult. Okay, so it's not expired yet, but it will expire soon. And if markets jump and you don't hedge, then you are in big trouble. Okay. Payoff is near 0. Well, it doesn't have to be. If markets suddenly move rapidly in the last few minutes. Okay. So that is that's this one. Now, question 1B, lecture 4, page 49, related to gap opening. The lecture note says if a stock gradually drops 5%, it is likely you have locked in the gamma along the way. I don't understand what lock in the gamma along the way means. Okay, now you know how the so-called gamma revenue, there's a very simple formula, a half gamma ds squared. Now, we don't ask you to remember many things for this course, but please, if you remember nothing else, remember this, okay? And the ex ante equivalent. This is ex post, this is after the fact. The ex ante equivalent is, so this is you could say this is actual. So this is the ex post. The expected is what? You should know that. So please remember these two. Okay. Now, so let's say you are long a call. So you long a call and you are short some stocks, and then this is time, and this is the price. So on day one, it goes up 2%. You don't really care whether it goes up or down. You just want it to go somewhere, okay? And then on day two, it goes up another 2%. And then on day three, it goes down. Or let's say it goes. We'll keep this example. It goes up 1%. Okay, so 3 times in a row, up and up and up, which has been happening. What they mean in that question is, oh, a stock drops. Okay, let's do it the other way. It drops 5%. Now, they're not specific about how long it took, but let's imagine it dropped 2%, it dropped 2%, and then it dropped another 1%. Okay, so minus 2, minus 2, minus 1. At the end of different days, let's imagine it happened like that. Okay, so what he means is if you are a trader, then at the end of every day, you would probably just try to cash in on your gamma revenue. Now, what does that mean? That means you will actually re-hedge and you become delta neutral again. Okay, because when the markets are moving, your deltas will change, and when you re-hedge, that would achieve two purposes. The first one is you will lock in your gamma revenue, number one. The second purpose is now you become delta neutral again, okay? Because don't forget, so if you're long a call and you are short some stocks and the market goes down, okay, you will make some gamma revenue. And then when you re-hedge, what you need to do is you actually need to buy some stocks because your delta is going down. If you're long a call, I'm talking about, okay? So in the course of doing that, because you sell high and then you buy low, you locked in that profit, okay? So that's what they mean by locking in the profit when you re-hedge, okay? Now, if you recall in the notes, in Gover's lecture notes, he makes a further point, okay? Because please remember, at the end of the day, when it's down 2%, I said you can re-hedge. You don't have to. We talked about this point in one of the tutorials. Now, if you don't re-hedge, what is good about that? Well, if you don't re-hedge, and if it keeps going down the next day, okay, first of all, if you re-hedge, your gamma revenue will be a half gamma, whatever gamma is, doesn't matter, times ds. ds is 2, and then you collect that on the first day and you collect that on the second day. That's if you re-hedge. Now, if you do not re-hedge, you just leave it and let it run, then over the course of 2 days, you will actually collect this. Now you can see, you can ignore the terms in the front, because here you got a 4, here you got a 4, but here you have a 16. So if you are certain that the market is going to continue, then you just leave it and you make more money. It's a bit like, those game shows on TV. You answer questions and then they say, okay, you want your gift now, or you want to answer more questions and get a car instead of a motorbike. Okay, and you're wondering, yeah, well, I don't know what's going to happen. So if you're risk averse, you want to lock it in. In the lecture notes, Govard actually mentioned that sometimes the decision is made for you when the market suddenly just gaps, 5 or 10%. It's not really up to you whether, do I want to wait or not, when the market's already moved that far. Yes. I mean here.
Yeah. Because for the middle one is the 2-day volatility.
Yeah. No, you don't have, no. When you are discussing gamma revenue, the three ingredients are, well, half is not really an ingredient, is the gamma right now, okay, and the actual movement. Oh, you are talking about this one. You're talking about this one.
Suppose if we have the annual volatility, which you divide it by 16,
Yeah.
and later that 4% volatility is for 2 days, so we should divide it by some kind of relationship between the 2-day volatility and 1-day volatility. Like if we have the annual volatility, we should divide it by 16.
Yes, I think you are right to say that. Okay.
Into my calculation, that it should be also 8 for the 2 days.
Are you talking about the one on the left-hand side or the right-hand side?
Right-hand side. May I use the example? I mean, the one.
Yeah, as long as you don't write on this one, because it doesn't come off. Yeah, sure.
It's for the 2-day volatility, and according to this one, and day is gamma times, let's say it's 1% movement is equal to 1 day times gamma times the volatility that it should be. And according to this equation, we can calculate the volatility for 1 day. And so we put in all these things. Is 2 day gamma times the 2%, 4% here. Yeah, it's 1 day gamma. That's what we're solving for. And we have this one solving by the equation. We know that is equal to is that right?
Yeah, I know what you're saying. What you are pointing out is that if in the course of 2 days your expected gamma revenue would be different because your volatility is now a 2-day volatility. Now, I agree with that. That is completely correct, and it's a very sharp observation. However, I guess my point here isn't about that. My point here is simply that in fact, for me, the sigma does not come into play at all. I am simply comparing two things. So At the end of day 1, the price has moved by 2, and at the end of day 2, the price has moved by 2 again. Okay, I am comparing between hedging at the end of every day and not doing that. Okay, now, in other words, I'm comparing what gamma revenue you will collect either way, and for that, it is such a simple equation. You just plug in the DS. I'll let you get that. You just plug in the DS. The sigma does not come in. What you just said is correct, okay? But it's not actually related here to this question, because so gamma doesn't change. So it's simply the square of this. So it's really a question of what you are squaring. Are you squaring 2 and then doubling it, or are you squaring 4? That's all it is. Yeah. Okay? Yeah. Now, lecture. So I'm going to tackle this now. Okay. There is a trick question. If there is Typhoon 8, what position would you prefer to be in? Just based on my understanding, the Hong Kong Stock Exchange will close when Typhoon 8 comes. It's true. That's when everyone becomes happy because they think they get a day off or half a day off. You know, it's funny, when I was working in regular employment, and I also thought like that, wow, there's a typhoon coming, let's pack our bags, go wash our hands and go home in half an hour. Now when I'm here, for me, it becomes a nuisance. It's a disruption, and it really screws up the schedule. That's just a digression. Okay, so I don't like typhoons anymore. I used to love them. What position would you prefer to be in? Just based on minus, they will close. It is true they will close. So the 1 day value of options just go away. I prefer to be premium short. Is there any other consideration I should think about, as this is a trick question? Well, I think there are actually 2 levels to a question like that. Level 1 is, so you have an option. So let's say today is so it's Monday, Tuesday, Wednesday, Thursday, Friday. So you are long a call here, and suddenly they call the typhoon, and then it looks like tomorrow is going to be off. So Wednesday afternoon you go home, and so guess what? You thought you had 2 days of optionality when you've only got 1. So if you are long, you are really not so happy about it, in the sense that when markets close, then obviously you can't trade and prices don't change, technically. That's the first level. The second level, however, the way I look at it is, just because your market is not open, things are happening elsewhere, and God knows what tweets Donald Trump might be sending around, and there are things happening in Korea and Japan and so on. So your prices are not moving, it's true, right? But it could be that when you come back on Friday, suddenly the market actually gaps up or down, which can in fact be to your benefit, right? So there are 2 ways to look at this. But I guess when Governor made the notes, he was mostly referring to level 1. Okay. Now, lecture 5 and 6, page 20. Maybe I should refer to lecture 5 and 6, page 24. So just look at the handout I gave you. Has everyone got a handout? Hello, Harsh. You don't have one? This might be the last one. If anyone else doesn't have one, wanted to share. So lecture 5 and 6, page 24. Normalizing delta and gamma example. Okay, now this is actually easier than you think. When normalizing a $200 stock into $100, delta should be times 2 and gamma should be times 4. I wonder how theta changes. That's a very good question. I intuitively think theta should also be times 4. Okay, now, however, from the gamma theta ratio, the ratio should be times. All right. Be kind to yourself, okay? Don't think yourself into a blinding corner. I'm going to try to unravel this stuff and make it simple for you. That's my job, okay? Not to make it complicated. Now, what the hell does normalizing mean? So all the Greeks that you have seen, I mean, look at this over here, okay? Now, these are what I call dollar Greeks. Okay, so you got a portfolio and gamma is 2. It's a dollar Greek. What I mean is a dollar Greek. What I mean by that is if the stock moves by, let's say, $1.50, then it's a half gamma ds square. You simply put the actual real dollar amount in there, and you would find your gamma revenue. That's what I mean is a dollar Greek. Okay. Now, dollar Greeks can be good because they tell you the actual exact monetary impact on your book when the underlying is moving by $1. Okay. However, it may not be always useful if you have a stock which is $100 now, and if that moves by $1, okay, compared to what you have another stock which is worth $70, and if that moves by $1, okay, I mean the percentage is different. So what you might want to do is, so you have a stock, and right now it is $200, and the delta, what did we say the delta was? 50. And gamma is 2. Okay, now that's what we're given. Now, in normalizing, the first step is I ask myself, what if this stock price changes by 1%? 1%, okay? Now, in that case, the change is actually $2, correct? Okay. So 1%, that's the first step I make, okay? So because the delta is 50 and the gamma is 2, so I know the gamma revenue will be a half gamma times the square of 2, right? Which is 4. I don't care about anything else. This is the first thing I want to think about, okay? What if it changes by 1%? What happens to my delta? Well, as you can see from the notes here, okay, so your delta is 50. So as I said, this is a delta, this is a dollar Greek. So the change because of the delta, change due to delta would be 100. And the change due to gamma would be 4. when the price moves by 1%. Now, 1% is a far easier concept for people to focus on. Is everyone okay so far? So I don't care what the stock price is right now, but they tell me it's 200, so I'll use that. Okay. So 1% of 200 is $2. So I want to work out the impact because of delta and the gamma revenue when there's a 1% price change. Everyone is okay? Okay, that's step one. Now step two, I pretend the stock price is 100. I know it isn't, okay? But I pretend it is. So I pretend stock price is 100, and then I ask myself, if the stock price was 100, what kind of Greeks would produce this kind of financial impact when there is a 1% move, which happens to be $1? Okay? And you can see that if the stock price was 100, in order for me to make $100 of delta impact, now the delta has to be 100. And in order for me to earn $4 of gamma revenue, and there's a $1 move, now the gamma has to be 4. And that's where these numbers come from. Here, and oh, it's 8. Because there's a half. Yeah. Okay. Sorry. Because you halve it. So a half gamma ds squared over here should be the same as a half gamma ds squared. Now the ds is 1 because I already said I pretend the stock price is 100 and I'm looking at a 1% movement. Okay, so gamma needs to be 8. Apologies. Oops. Okay, so that's how you do it. So first, think of a 1% move of your current stock price. What is the real, actual, direct monetary impact of that? And then you pretend that the stock price is 100, and then you figure out, what, and then there's a 1% move, which happens to be $1. Okay, there's a 1% move. How do you adjust your Greeks so that you actually have the same, you produce the same financial result? Okay, so that is what we mean by normalizing your Greeks. All right. Now I need to press on. So let me get on to the next one. Yeah. Thank you. Yeah. I wonder. Yeah. I wonder how theta changes. Well, that's actually the important part. Now, theta here would be a half gamma sigma s all squared. Now we are not actually given sigma here, so but let's pretend that we know. We don't know, okay? But suppose we know. The thing about theta is it is actually different from delta and gamma. Now, the reason I need to make adjustments here is that delta and gamma are related or connected to price changes. So when I start normalizing things, different price change would have different impact. Theta is a measure of how my book will lose money from one day to the next. So you can actually determine what the theta is for your actual portfolio here. But whether you normalize or not, there are no adjustments to make, okay? Because the price change is not involved. So you are only making adjustments to delta and gamma because they are related to change in price. Theta is not, okay? So in other words, the conclusion is when you are normalizing your Greeks for theta, there's nothing to normalize, okay? Very good question then. Okay, now lecture 5 and 6, page 59. We have worked out that volatility 60 to 90 is negative. Then it says buy the 90-day, sell the 60-day. I'm curious about the rationale. With why the negative can suggest buying 90-day and selling 60-day. Additionally, if volatility is positive, can the positive vol suggest inverse strategy? Okay, this question is related to the forward volatility that we've been talking about. And if you imagine if this is the 60-day vol, and this is the 90-day vol, okay, then it is possible, just like in interest rates, it is possible to try to work out what is the volatility from 60 to 90, because when you have X and Y and Z, then Z is actually a function of X and Y. I mean, that should be obvious to you, okay? Now, this is like forward interest rates. It's a similar concept. The point here is, not everyone in the market is busy every day looking at the forward volatilities. I mean, some people do, okay? But the mums and dads who are punching away at the brokerage and buying warrants, probably they're not, okay? So it is possible sometimes for markets to get sort of out of sync, and the forward volatility can be up and down and sometimes quite irrational. When I was a junior, I remember the senior traders they said, Sam, most of the money in derivative trading is made in the forward markets. I never really understood what that meant. But over the years, now I think I do, okay? Because let's take interest rates for an example, okay? So 1 year interest rate is 2%, and 2 year interest rate was 2-year interest rate is 3.25. Okay. Now, is it immediately obvious to you what the 1-year rate in 1 year is? No, it is not. You have to go and calculate it. Right? It's not shown in the markets, and people do not have, ready access to that as much as they do on the spot rates. So when you start trading forward rates and you see anomalies, sometimes you can take advantage of it. Now, so here the point is, so you can see because X is up here and Y is down here, so EZ, being a kind of geometric average, should be somewhere in the middle. But if X was very, very high, if X was unusually high, okay, then in order to have, an average like EZ, then Y has to go in the other direction, doesn't it? You can imagine that. This being kind of average. So as this goes up, if this doesn't move, then this one has to come down. It has to be like that. Yeah? And the point of this observation is that sometimes when Y becomes very, very low, or even zero, or even negative, okay, then there is an opportunity to buy. Now, is everyone okay on that point? Yeah. So when Y is very low, because for some reason X is going crazy up there, okay, Y goes the other way, then it is possible for you to buy. Now, technically, there is no reason why an option should trade with negative volatility. Just like, how much does this cost? I don't know, $200. Okay. There's no reason why the price of this should be negative. Okay. It's not poison. Okay. Negative means I pay you money to give it to you. The worst it can be should be zero. Okay. So the point about this question is that if it's zero, you should certainly buy it. If it's negative, that is basically a free option. So definitely you will buy it. Okay. Of course, it can get even more negative, in which case you are staring at least temporarily, a negative mark to market. Now, the reverse may not be true. Additionally, if the forward vol was positive, can the positive volatility suggest inverse strategy? That's a good point. So now we flip the question around. So let's say this was the 60-day, and this was a 90-day. Then between 60 and 90, it will be up here somewhere. Now, the two are not necessarily symmetric. What I mean by that is, if I tell you this thing is worth zero, or even negative, let's say it's zero. Okay? So this thing is free, or it costs you 10 cents. Would you buy it? Yeah, you would, because it's so cheap. Okay? But if, on the other hand, this thing costs $100, so now it's positive, what I mean. Now it's positive, so it's $100. Do you short sell? Well, I don't know. Is it high enough? It can actually get even higher. Okay? So if it hits the roof, then maybe you want a short sell. But there is not a perfect symmetry, because if something is negative, that means it's free. You definitely will buy it. But if something is positive, it could be priced at a fair value or it may not be. Okay, so you have to make a decision on that. Okay. All right, now lecture notes. Only tell us how to calculate synthetic row and what defines the row of an individual option. Also, the note says the row of a synthetic is distributed between calls and puts through the delta. I want to know whether this distribution is proportional to delta. Assume the row is 10 in a synthetic, call delta is 60 and put delta is minus 40. Does it mean the row of a call is 6, row of a put is minus 4? Additionally, is there any exact formula of row with respect to time to maturity? Yes, there is a formula for it. I will show you in a minute. No, it's not linear. It's not that simple. All right, I need to jump forward a little bit. Okay. I have a page. This is talking about the forward vol. So you should know that by now. Okay. Now I've collected the Greeks here. Now this is when you differentiate the Black-Scholes call and put formula with respect to price, and then the second derivative, and you differentiate with respect to time, with respect to sigma, and with respect to interest rates. These are the actual formulas. Have you actually seen them anywhere else? You have, right? So the point here is when you add up these two, okay, the row of that will always be a constant, and the reason is if you are long a call, let's say, okay, first of all, what is row? Okay. Row is the sensitivity of option price when interest rate changes. By the way, it's not a very important, or it's a less important Greek. It's like the poor cousin living around the corner. Okay, it's not the most important member in the Greek family, but it is the change of your option price when interest rate changes. And if you are long a call, and if you are short a put, you add them together, you just have a linear payoff. Okay. Now this of course is still a combination of these two. So there is a row for calls, there's a row for puts. It's just that when you add them together, now it's not so interesting. So you know that the row of long call and short put can always be decomposed into the row of a call and the row of a put. You just don't know what is the composition, okay? And the composition is what you see here. So it is not linear, and it is driven by these two formulas here, all right? Now the KTs don't move because they're constant, but the ND term is not linear. And while we're on this subject, this is in the tutorial. I try to put down why these funny looking graphs. You know, in the derivative world, in all of option trading, this is, for me, is close to being an art because it's not symmetric. I really like it when things are not symmetric because I want to know why. Okay? So here they are not symmetric. The change of row or a call when the strike price is changing. This is kind of a funny way of looking at it. So it's saying that the stock price is now around 50. But if you look at different calls with different strikes, okay, the rows would look like that. So you are keeping the stock price constant and looking at maybe 80 different options and how the row would behave. It is another way of saying, if you have a stock and you have an option, how does the row behave when it's at the money? Okay? How does it behave when it's deep in the money or deep out of the money? Which is over here. Oops. And for puts, of course, it's the other way around. And I have written some notes here where I try to explain why these funny looking graphs are like that. Okay. I think it might be easier you just try and read that. And if you have any questions, you just come back to me. Okay. I think the more I explain here, the more you can get confused. That's been my experience. But I will give you these slides. Okay. Now, what was the next question? The person asking me all these questions will get participation points. I'll tell you that now. Okay. The distribution is not proportional to delta, but it is driven by it. Okay. And you can tell that here just by looking at a very simple plain vanilla option, which is at the money. Once you get a little bit out of the money, you can see that the rows are changing, but not in the same proportion as the row. Okay, so the delta is changing, but not, or I should say the row is changing, but not in the same proportion as the delta. Okay. That's a very good question. Okay, so do you guys want to take a short break? Yeah, so why don't we do that?